Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by Strategas founding partner and chief economist Don Rissmiller to talk all things markets. Don, how are you doing today?
Very good, Ross. Happy holidays. Good to talk with you.
Great to chat with you as well. We're talking at a bit of a moment of euphoria for the markets. We've been on this rally. The Fed has made what I would describe as a dovish pivot on the back of some weaker than expected inflation data and some resilience in the economic data. So I guess I would ask you this to start, moving into 2024, how do you assess the odds of a soft landing going forward with all of the new data that we've gotten in the last couple of months?
Yeah, it's an important question. And so there are a number of indicators that we've relied on historically. In 2023, some of them did a good job and some of them did less of a good job. And so the items that did a good job this past year, so that's things like jobless claims, that's things like credit spreads, they're continuing to signal growth, and that's consistent with where real gross domestic product is tracking in the fourth quarter. We're likely to see a positive number in the fourth quarter, even though it's probably slower than the third quarter here in the US. Now, the indicators that have really not provided a good signal, it's the yield curve, it's the purchasing managers index, which has been in contraction territory now for a number of quarters. So as we try to weight those, there are still the lagged effects of policy restraint hitting the US economy. Abroad, we're seeing much weaker data. If we look at Germany, even Canada or other countries nearby, we are seeing some of that more traditional pass-through of monetary policy to the economy. But until some of the timely indicators on the labor market, like jobless claims or credit indicators, give us some signal that something is different, I think we have to consider the possibility that the Fed can pull this off. Maybe other central banks can't pull this off without a negative GDP quarter or a recession, but the Fed has a shot here because of some unique US items. And so as we start 2024, there's still a possibility of a downturn from the lagged effects of what's been put in place. But if we get to mid next year, especially as we move towards the election in the second half of next year, we're likely to see some additional cushion. So if there's going to be weakness, I think it's in the first half of next year, really within the next 6 months or so.
So the data has been good, and that's signaling, soft landing or at least resilience in the economy. But I think to achieve this fully, you always needed the Fed to get on board and feel confident enough in the inflation picture to start to maybe ease rates before a recession hit. There was what was perceived as a dovish pivot from the Fed at their recent meeting. The rally in equities has really taken off since then. But does it seem to you like the market is getting a bit ahead of themselves? Do you think the Fed will actually meet the market where they're at as far as rate cuts in the first half of next year? Or do you think there's a bit of optimism in equities and in bond market right now about what the Fed is going to be able to do next year?
So the first thing I'd say is the market seems to be ahead of the Fed. That I think we can say with some confidence, especially given some of the Fed speeches over the last few days that have said, okay, there was a dot plot that came out, the Fed had their own forecasts. They were not showing what the market is showing in terms of rate cuts, in terms of the magnitude or even the potential for the speed when they start next year. So the market does seem to be ahead of the Fed. The Fed seems to be focused on the real rate picture, and if inflation moderates, you would have to tweak the nominal interest rate lower to maintain the same real rate position. And so from that point of view, you could have some, let's say up to 3, like the dot plot suggested, rate cuts just on a technical adjustment between nominal and real interest rates. The market, which is ahead of the Fed, would be right if the economy weakens. So there is a case where, let's say, the bond market is more right than the Fed would come towards what the bond market is suggesting. But I think you need to have a negative payroll print, maybe a negative GDP print, before you would get that. So that's where I see the biggest disconnect. The Fed is thinking of it more as a technical adjustment to maintain the same real rate, whereas the bond market is pricing in a lot of other possibilities.
Right. That makes a lot of sense. Let's end here. Don, what is the number one or most important indicator that you're watching in 2024? Is it the labor market? Is it consumer spending? What do you think is the most important thing that might dictate how the year goes for the rest of the economy?
Those are very important considerations, and timely data like initial jobless claims that we get every week will give us information. But I'd add to that list the credit market. So we have not seen much credit strain. We've seen some strain in the banking system. We've seen bank lending standards tighten. But if we look at credit spreads and they don't show much movement, that's going to suggest a much more resilient economy, even in the first half of next year.
Perfect. Well, Don, we appreciate it as always. Thank you so much for the time, and we'll look forward to talking to you again in 2024.
Take care.